in analysis, this point usually requires an investigation going well beyond the reported figures. The following examples will illustrate the type of situation and analysis with which we have been dealing. Example A. Purity Bakeries Corporation. This large maker of bread and cake operates through a number of subsidiaries, of which one of the largest is Cushman's Sons, Inc. of New York. Cushman's has outstanding $7 and $8 cumulative preferred stock not guaranteed by Purity. The annual reports of Purity are on a consolidated basis and show earnings after deduction of full dividends on those Cushman's preferred shares not owned by Purity, whether earned or paid. The separate reports of Cushman's reveal that between 1934 and 1937, its operations resulted in a considerable loss to Purity on its accounting basis. These may be seen in the accompanying PDF. The earnings are thus seen to be 3 times as large excluding Cushman's as they were including Cushman's. Could the analyst have reasoned that the former provides the truer measure of Purity's earning power, since the company can be expected either again to earn money from that subsidiary, as it had earned it in the past up to 1934, or to drop it? The question of intercorporate relationships would have to be considered. A note in the 1937 report of Cushman's indicated that Purity was making a fairly large service charge in connection with its subsidiary's operations, which suggests that Cushman's might be of some extra value in absorbing overhead. This matter would call for a careful inquiry. But the report for the next year, 1938, showed first that Cushman's had earned the preferred dividend deduction, and secondly, that 2 unprofitable retail plants in Philadelphia and Chicago had been closed. Subject to further investigation, therefore, the analyst might well infer that the subsidiary's losses were non-permanent in nature, and that the reported results for 1934 to 1937 are to be viewed with this point in mind. Example B. Lehigh Coal and Navigation Company. This enterprise has derived its income from various sources, chief of which has been the lease of its railroad property to the Central Railroad of New Jersey for an annual rental of $2,268,000. Its next largest holding consists of anthracite coal mines, which since 1930 have been operated at a loss. In 1937, this loss was equivalent to about 90 cents per share of Lehigh stock. As a result, the company reported a consolidated net loss of $306,000 for the year, as contrasted with a profit on a parent company basis only of $1,125,000 or 64 cents per share. But in this case, the analyst could not safely make the assumption that the Lehigh stock was not worth less by reason of its ownership of the mining properties than it would be worth without them. Operation of the mines supplied an important tonnage to the railroad division. If the mines were shut down, the ability of the Jersey Central to pay the annual rental might have been critically impaired, especially since the lessee road had been doing poorly for some years past. In fact, the claim was later made by the Jersey Central that the Lehigh Coal and Navigation was obligated in connection with the lease to supply a certain tonnage from its coal properties. Hence, in this rather complicated setup, the investor could not safely go behind the consolidated results, including the losses of the anthracite subsidiary. Example C. Barnsdall Oil Company. We have here a situation opposite from the other two. Barnsdall Oil owned both refining and producing properties, the latter profitable, the former unprofitable. In 1935, it segregated the refineries and marketing units in a separate company, of which it distributed the common stock to its own stockholders, retaining, however, the preferred stock and substantial claims against the new company. In 1936 to 1938, the refineries and stations continued to lose. Barnsdall Oil advanced considerable sums to cover these losses and wrote them off by charges first against capital surplus and then against earned surplus. On the other hand, its income account freed from the burden of these refining losses, showed profits from producing operations at a steady rate from June 1, 1933 to the end of 1938. In 1939, however, the New York Stock Exchange called upon the company to correct its statements to stockholders by advising them of the effect upon the reported profits of charging there against the write-downs of the investment in the refining company. These losses would have reduced the indicated profits by more than one-third. It is clear from the standpoint of proper accounting that as long as a company continues to control an unprofitable division, its losses must be shown as deductions from its other earnings. The analyst must decide what the chances are of terminating the losses in the future and view the current price of the stock accordingly. The method followed by the Barnsdall Oil Company appears therefore clearly open to criticism, since it served merely to terminate the reporting of its refining losses without really terminating the losses themselves. At the end of 1939, the company set steps into motion for an apparent complete divorcement and sale of the refining and marketing divisions. Summary. To avoid leaving this point in confusion, we shall summarize our treatment by suggesting: 1. In the first instance, subsidiary losses are to be deducted in every analysis. 2. If the amount involved is significant, the analyst should investigate whether or not the losses may be subject to early termination. 3. If the result of this examination is favorable, the analyst may consider all or part of the subsidiary's loss as the equivalent of a non-recurring item. Chapter 34. The relation of depreciation and similar charges to earning power. A critical analysis of an income account must pay particular attention to the amounts deducted for depreciation and kindred charges. These items differ from ordinary operating expenses in that they do not signify a current and corresponding outlay of cash. They represent the estimated shrinkage in the value of the fixed or capital assets due to wearing out, to using up, or to their approaching extinction for whatever cause. The important charges of this character may be classified as follows. 1. Depreciation and obsolescence, replacements, renewals, or retirements. 2. Depletion or exhaustion. 3. Amortization of leaseholds, leasehold improvements, licenses, etc. 4. Amortization of patents. All these items may properly be embraced under the title amortization, but we shall sometimes refer to them generically as depreciation items or simply as depreciation because the latter is a more familiar term. Leading questions relative to depreciation. The accounting theory that governs depreciation charges is simple enough. If a capital asset has a limited life, provision must be made to write off the cost of that asset by charges against earnings distributed over the period of its life. But behind this innocent statement lie complications of a threefold character. First, we find that accounting rules themselves may permit a value other than cost as the base for the amortization charge. Second, we find many ways in which companies fail to follow accepted accounting practice in stating their depreciation deduction in the income account. Third, there are occasions when an allowance that may be justified from an accounting standpoint will fail to meet the situation properly from an investment standpoint. These problems will engage our attention in this and the next two chapters. Our discussion will be directed first towards industrial companies generally, following which we shall consider special aspects having to do with oil companies, mining companies, and public utilities. The depreciation base. Depreciation base other than cost. There is support in accounting circles for the theory that the function of the depreciation allowance is to provide for the replacement of the asset at the end of its life rather than merely to write off its cost. If this idea were actually followed, the current or expected future replacement cost would be the basis for the depreciation charge, and it would vary not only with the value of the identical asset, but also with changes in the character of the item that is expected to replace the one worn out. Whatever may be said for or against this theory, it is virtually never followed in the form stated. But we do meet in practice with a variant of the idea, viz., the substitution of the replacement value of all the fixed assets as of a given date in place of cost on the balance sheet, followed usually by annual depreciation charges based on the new value. Since 1914, there have been two waves of such revaluations. The first, taking place in the 1920s, marked up pre-war costs to the higher values currently prevailing. The second, appearing in 1931 to 1933, marked down property accounts to the much lower valuations associated with the Depression. Examples. In 1926, American Ice Company wrote up its fixed assets by $7,868,000, and in 1935 it wrote them down correspondingly to restore the valuations to a cost basis. The 1926 write-up resulted in larger depreciation charges thereafter against income, and the 1935 reduction resulted in lower depreciation charges. In 1933, American Locomotive Company reduced the stated value of its stock from $50 to $5 a share and utilized most of the capital surplus thus created to write down fixed properties by nearly $26 million and its investment in General Steel Castings Corporation by about $6,200,000. The net effect on the income account was to reduce depreciation charges to about 40% of their former level. There is some criticism in accounting circles of the propriety of such sporadic changes in the depreciation base from original cost. In our opinion, they are not objectionable provided 1. The new values are set up in the bona fide conviction that they represent existing realities more fairly than the old values. 2. Proper depreciation against these new values is charged in the income account. In many cases, however, we find that companies revaluing their fixed assets fail to observe one or the other of these conditions. Markdowns to reduce depreciation charges. Perhaps the most striking phenomenon in the field of depreciation accounting is the recent marking down of the fixed assets, not in the interests of conservatism, but with the precisely opposite intent of making a better earnings exhibit and thereby increasing the apparent value of the shares. We believe that it will be more convenient for the reader if we defer consideration of the significance to security analysis of these devices until our chapter devoted to amortization charges from the investor's standpoint. At this time, since we are dealing with accounting methods, we shall merely remark that in our opinion, excessive write-downs of fixed assets for the avowed or obvious purpose of decreasing depreciation and increasing reported earnings constitute an inexcusable subterfuge and should not be condoned by the accounting profession. Registration statements submitted to the SEC include a statement of how much lower the earnings would have been if the former plant values had been retained. We think that such information should also appear as a footnote to the income account in the annual reports to stockholders, but it would be better practice still if accountants refused to certify a report containing such markdowns and insisted on restoration of the proper figures to the company's accounts. Balance sheet income account discrepancies. Many corporations that have marked up their fixed assets fail to increase correspondingly their depreciation charges against the income account. They are in effect attempting to get the benefit of the higher valuation in their balance sheet without accepting the burden of consequently higher depreciation charges against earnings. This practice has been especially prevalent in the case of mining and oil companies. Two examples drawn from the general industrial field are given here. Examples. Hall Printing Company wrote up its property account by $6,222,000 in 1926 and 1931, crediting this appraisal increment to capital surplus. Depreciation on this appreciated value was then charged to capital surplus instead of to income. For example, typically in the year ended March 1938, the company charged $406,000 for such depreciation against surplus and $864,000 for regular depreciation against income. In April 1938, The balance of the appraisal increment was eliminated by writing down both property account and capital surplus, and the special depreciation charge was then discontinued. Borg Warner has been charging about $102,000 per annum since 1935, and various amounts in prior years, to appreciation surplus instead of to income, to amortize a write-up of fixed assets made in 1927. It should be obvious that no company should use one set of values for its balance sheet and another for its income account. The more recent tendency is to correct these disparities by eliminating the previous write-up from the balance sheet, thus returning to original cost. The rate of depreciation, standard and non-standard practice. 1. As shown by listing statements. The vast majority of industrial companies follow the standard policy of charging an appropriate depreciation rate against each class of depreciable asset. The analyst can readily check this fact by reference to New York Stock Exchange listing applications or to a prospectus or registration statement. Examples. If standard methods are followed, they are likely to be announced in somewhat the following manner. From listing application of electric storage battery company dated December 17, 1928. The policy of this company in regard to depreciation is as follows. On buildings, the term of life is 20 to 33 years depending upon the character of construction. Machinery, tools, and fixtures are written off at the rate of 1 to 10 years depending upon the character of the equipment. Office furniture and fixtures are written off in 10 years. On all depreciable properties, rates are determined by actual experience and engineers' estimates as to the productive life of the equipment. In respect to depreciation of current assets, a reserve is set aside to cover probable loss from bad debts. From the listing application of Midland Steel Products Company, dated February 11, 1930. The following are the rates of depreciation used. Buildings, rate of depreciation per year, 2%. Grounds, driveways, and walks, 2%. Machinery, 7%. Furniture and fixtures, 10%. Railroad sidings, 2%. Automobiles and trucks, 25%. Tools and dies, amortized over life of job when number of units required can be determined, otherwise written off at close of each fiscal year. These rates have been used by the company for several years, being standard practice in the industry. The rates are based upon the estimated life of the respective property involved. Thus, with respect to buildings, the cost is depreciated over 50 years, grounds, driveways, and walks over 50 years, machinery over 14 years, furniture and fixtures over 10 years, railroad sidings over 50 years. No residual value at the expiration of said periods is considered in determining the rates used. In contrast with this standard policy, now all but universally followed, we may point to the questionable practice on this important point formerly resorted to by such important companies as American Car and Foundry, American Sugar Refining, and Baldwin Locomotive Works. The American Sugar Refining Company's listing application, dated December 6, 1923, contained the following statement. The company maintains a very liberal policy as to depreciation as shown by the annual profit and loss statement of past years. The value of its properties is at all times fully maintained by the making of all needful and proper repairs thereto and renewals and replacements thereof. This declaration sounds reassuring, but it is far too indefinite to satisfy the analyst. The actual depreciation charges, as shown in the following record, which may be found in the accompanying PDF, disclose an unusually arbitrary and erratic policy. The additional charges to surplus made in the years 1926 to 1930, inclusive, appear to strengthen our contention that American Sugar's depreciation allowances have been both arbitrary and inadequate. The American Car and Foundry's application, dated April 2, 1925, contains the following. The company has no depreciation account as such. However, its equivalent is found in the policy and the practice of the company to maintain at all times its plants and properties in first-class physical condition and in a high state of efficiency by repairing, renewing, and replacing equipment and buildings as their physical conditions may require, and by replacing facilities with those of more modern type when such action results in more economical production. This procedure amply covers depreciation and obsolescence, and the cost is charged to operating expenses. Here again, a skeptical attitude on the part of the analyst is amply warranted. The same is true in respect of American Can, which managed, inexplicably, to avoid all reference to its depreciation policy in its listing application dated February 26, 1926, although it did mention that the company had spent approximately $50 million on extensions and improvement of properties since February 1907, and that during this period properties have been depreciated by at least $20 million. Baldwin Locomotive Works, in its listing application dated October 3, 1929, makes the following rather astonishing statement on depreciation. The amount of the depreciation upon plant and equipment as determined by the federal government for the 5 years 1924 to 1928 inclusive has totaled $5,112,258.09, which has been deducted either from income or surplus as follows. This chart may be found in the accompanying PDF. It is expected that in future years the amount of depreciation based upon the estimated useful life of depreciable properties as determined by the federal government, allowed by the Commissioner of Taxes as a proper deduction from income and agreed to by our engineers, will govern the amount to be used by the works in its calculation of depreciation. Evidently, the income statements of Baldwin for this period were anything but accurate. The average annual earnings per share of common stock for 1924 to 1928, as reported to the stockholders, were strikingly higher than the correct figure. 2. As shown by comparisons of two companies. When the analyst knows that a company's depreciation policy differs from the standard, there is special reason to check the adequacy of the allowance. Comparison with a single company in the same field may yield significant results, as is shown by the table in the middle of page 460, found in the accompanying PDF, respecting American Sugar and American Car and Foundry. Both comparatively and absolutely, the depreciation allowances made by American Sugar and American Car and Foundry appear to have been inadequate. Depreciation charges often an issue in mergers. Comparative depreciation charges at times become quite an issue in determining the fairness of proposed terms of consolidation. Example: in 1924, a merger plan was announced embracing the Chesapeake and Ohio, Hocking Valley, Pere Marquette, Nickel Plate, and Erie Railroads. Some Chesapeake and Ohio stockholders dissented, and they convinced the Interstate Commerce Commission that the terms of the consolidation were highly unfair to their road. Among other matters, they pointed out that the earnings of Chesapeake and Ohio in the preceding 3 years had in reality been much higher than stated, due to the unusually heavy charges made against them for depreciation and retirement of the equipment. A similar objection was made in connection with the projected merger of Bethlehem Steel and Youngstown Sheet and Tube in 1929, which plan was also defeated. Some figures on these two steel producers are given as shown in the table on page 462, found in the accompanying PDF. Concealed depreciation. That nothing can be taken for granted in security analysis is shown by the strange case of American Can, which until 1937 had failed to reveal details of its depreciation policy to its shareholders. During the years 1922 to 1936, it deducted annually a flat $2 million for this purpose. A comparison with Continental Can, which charged about the same amount against a much smaller plant investment, would have suggested that American Can's earning power had been overstated. But the annual report for 1934 disclosed to stockholders for the first time that the company had also been charging sums to operating expenses for replacements without giving the amount. The fact, but not the amounts, that such charges had been made in 1935 and 1936 was also revealed in those years. Meanwhile, Form 10-K for 1935, filed with the SEC, revealed that the amount of these extra charges was about $2,400,000. Finally, the annual report for 1937 advised the stockholders that the corresponding extra charge-off amounted to approximately $3,275,000 for the year 1936. Beginning with 1937, the company made regular depreciation charges, amounting to $5,702,000 in that year and to $6,085,000 in 1938. Thus, by easy stages, the owners of the business were told the facts of life bearing on their property. In the light of this later disclosure, the earlier inference that American Can had understated its depreciation charges must give way to the remark that the company had failed to reveal the facts. A case of excessive depreciation charges concealed by accounting methods. The American Can example suggests comparison with the earlier practice of National Biscuit Company, an enterprise controlled largely by the same interests. For many years prior to 1922, the company was constantly adding to the number of its factories, but its property account failed to show any appreciable increase, except in the single year 1920. The reports to stockholders were supremely ambiguous on the matter of depreciation charges, but according to the financial manuals, the company's policy was as follows. Depreciation is $300,000 per annum, and all items of replacement and building alterations are charged direct to operating expense. It is difficult to avoid the conclusion, however, that the capital investments in additional plants were actually being charged against the profits and that the real earnings were, in all probability, much larger than those reported to the public. Coincident with the issuance of 7 shares of stock for 1 and the tripling of the cash dividend rate in 1922, this policy of understating earnings was terminated. The result was a sudden doubling of the apparent earning power, accompanied by an equally sudden expansion in the plant account. The contrast between the two periods is shown forcibly in the table that may be found in the accompanying PDF. Failure to state depreciation charges. Prior to the SEC regulation, some of the important companies reported earnings after depreciation, but failed to state the amount deducted for this purpose. Fortunately, this information must now be supplied in the case of every registered company. Amortization charges of oil and mining companies. These important sectors of the industrial field are subject to special factors bearing on amortization. In addition to depreciation in the ordinary sense, which they usually calculate in the same way as do other companies, they must allow for depletion of their ore or oil reserves. In the case of mining concerns, there is also the factor of development expense. Oil producers, on the other hand, have additional charges for intangible drilling costs and for unproductive leases. These items are important in their bearing on the true profits, and they are troublesome because of the varying methods that are followed by different enterprises. Depletion charges of mining companies. Depletion represents the using up of capital assets by turning them into products for sale. It applies to companies producing metals, oil and gas, sulfur, timber, etc. As the holdings or reserves of these products are exhausted, their value must gradually be written off through charges against earnings. In the case of the older mining companies, including particularly the copper and sulfur producers, the depletion charges are determined by certain technical requirements of the federal income tax law, which rest upon the amount and value of the reserves as they were supposed to exist on March 1, 1913, or by applying certain percentages to the value of the product. Because of the artificial base used in these computations, many companies have omitted the depletion charge from their reports to stockholders. Independent calculation by investor necessary. As we shall show later, the investor in a mining concern must ordinarily compute his own depletion allowance based upon the amount that he has paid for his share of the mining property. Consequently, a depletion charge based either on the company's original book cost or on the special figure set up for income tax purposes would be confusing rather than helpful. The omission of the depletion charge of mining companies is not to be criticized, therefore, but the stockholder in such enterprises must be well aware of the fact in studying their reports. Furthermore, in any comparison of mining companies, a proper distinction must be drawn between those which do and those which do not deduct their depletion charges in reporting their earnings. Following are some examples of companies that pursue one or the other policy. Companies that report earnings without deduction for depletion: Alaska Juneau Gold Mining Company, Anaconda Copper Mining Company, Dome Mines Limited, Gold, Kennecott Copper Corp., Noranda Mines Limited, Copper and Gold, Texas Gulf Sulfur Company. Companies that report earnings after deduction for depletion: Cerro de Pasco Copper Corp., Granby Consolidated Mining, etc. Company, Copper, Homestake Mining Company, Gold, International Nickel Company of Canada Limited, Patino Mines, etc. Tin, Phelps Dodge Corp., Copper, St. Joseph Lead Company. Depletion and similar charges in the oil industry. In the oil industry, depletion charges are more closely related to the actual cost of doing business than in the case of mining enterprises. The latter ordinarily invest in a single property or group of properties, the cost of which is then written off over a fairly long period of years. But the typical large oil producer normally spends substantial sums each year on new leases and new wells. These additional holdings are needed to make up for the shrinkage of reserves through production. The depletion charge corresponds in some measure, therefore, to a current cash outlay for the purpose of maintaining reserves and production. New wells may yield as high as 80% of their total output during the first year. Hence, nearly all the cost of such flush production must be written off in a single fiscal period, and most of the earnings from this source are in reality a return of the capital expended thereon. If the investment is not written off rapidly through depletion and other charges, the profit and the value of the property account will both be grossly overstated. In the case of an oil company actively engaged in development work, the various headings under which write-offs must be made include the following: 1. Depreciation of tangible assets. 2. Depletion of oil and gas reserves based upon the cost of the leases. 3. Unprofitable leases written off. Part of the acquisitions and exploration will always prove totally valueless and must be charged against the revenue from the productive leases. 4. Intangible drilling costs. These are either written off at one time as equivalent to an operating expense or amortized over the life of the well. Example: the case of Marland Oil in 1926 illustrates the extent to which reported earnings of oil companies are dependent upon the accounting policies with respect to amortization. This company spent large sums annually on new leases and wells to maintain its rate of production. Prior to 1926, it charged the so-called intangible drilling costs to capital account and then wrote them off against earnings through an annual amortization charge. In 1926, Marland adopted the more conservative policy of charging off all these intangible costs currently against earnings. The effect on profits is shown in the table that may be found in the accompanying PDF. In the past 10 years, significant changes have occurred in the policies followed by the important oil companies. Prior to the Depression, the general tendency was towards charging the intangible drilling costs to earnings, as shown in the change made by Marland in 1926. But since the Depression, many of the large companies have switched over to the less conservative basis of capitalizing these costs subject to annual amortization. This change seems justified in good part by the wide adoption of state proration laws, which effectively spread out the total production of a new well over many years instead of concentrating it within a relatively few months. This makes an oil well a fairly long-term capital asset, so that charging off a good part of its cost, now often running to very high figures, against a single year's profits would be unduly severe. The companies have also aided their earnings by large write-downs of fixed assets, with corresponding reductions in the annual amortization charges against them. This practice has perhaps been more widespread among oil companies than in any other industrial group. Some producers have also switched their charges for property retirements from earnings to the depreciation reserve. Finally, we have examples of a reduction in amortization charge being brought about by adoption of an overall basis instead of a lease basis for depletion. By this means, oil produced from high-cost leases is written off not at its actual cost, but at the average cost of all the oil reserves owned. The significance of these changes in accounting policy is illustrated by the following. Examples. Gulf Oil Corporation increased its 1932 earnings by $3,621,000 by capitalizing intangible drilling costs instead of charging them off as formerly. Saucony Vacuum increased its 1932 earnings by $6,095,000 and subsequent earnings correspondingly as a result of a write-down of fixed assets with consequent reduction in depreciation charges. In 1935, its profits were increased $1,376,000 by charging this sum, representing losses on certain retired property, to depreciation reserve instead of to income as theretofore. In 1936, it began to capitalize intangible drilling costs, adding about $8,850,000 to profits in that year through this change. In 1937, the company made a further revision in its depreciation policy, apparently intended to place it on the standard basis, which added some $2,500,000 to that year's profits. Pure Oil Company reduced its 1934 depletion charges and increased its earnings by $1,698,000 through adoption of the overall basis. The meaning of these variations to the analyst and the investor. These differences of accounting methods are highly confusing and may arouse some resentment in the investor. We must recognize, however, that most of them are technically admissible in that they represent choices between the ordinary and the more conservative basis of amortizing the fixed assets. What is called for, in consequence, is not so much censure as sound interpretation. Suggested standards. The analyst should seek to apply a uniform and reasonably conservative rate of amortization to a property base that reflects the realities of the proposed investment. We suggest the following standards insofar as it may be feasible to apply them. 1. Depreciation on tangible assets. This should always be taken at the well-established rates applied to cost or to a figure substantially less than cost only if the facts clearly justify the write-down. 2. Intangible drilling costs. We believe that capitalizing these costs and then writing them off as oil is produced, although less conservative, is the preferable basis both for comparative purposes and to supply a fair reflection of current earnings. In comparing companies that use one and the other method, the analyst must make the best allowance he can for the understatement of earnings by the companies that charge off 100% the first year. Example. The difficulty of making this adjustment in practice may be shown by comparing the 1938 reports of Continental Oil Company and Ohio Oil Company. These two concerns are roughly similar in their setup. Both produced about 20 million barrels in 1938. Continental Oil refined about 2/3, and Ohio Oil about 1/3 its output. Continental charges all its intangible drilling costs direct to income, while Ohio capitalizes these costs and writes them off over the life of the wells. It might be expected that the total amortization charges of Continental, including drilling expense on the 100% basis, would be relatively higher than those of Ohio. Yet in 1938, Ohio charged off $11,602,000, or 21.5% of its $54 million sales, while Continental charged off $14,038,000, or 17.6% of its $80 million gross. Apparently, no adjustment would be needed by the analyst to equalize the two accounting methods. The reasons may be found in several circumstances. For example, A, after a number of years, the gradual write-off method approximates the 100% method, since amortization of old drilling expense becomes continuously greater. B, in the case of Continental, this concern wrote down its property account in 1932 by some $45 million, and thus reduced its normal depreciation and depletion charges considerably in succeeding years. 3. Property retirement and abandoned leases. We think that loss on property retired in excess of depreciation already accrued should be charged against the year's earnings rather than against surplus, as is done by most companies in other fields. The reason is that property retirements are likely to be a normal and recurrent factor in the business of a large integrated oil company instead of happening only sporadically as in other lines. Abandoned leases come under this general heading, and the loss thereon should be charged to earnings. 4. Depletion of oil reserves. The proper theoretical principle here is that the analyst should allow for depletion on the basis at which the oil reserves are valued in the market. This point, as applied to amortization generally, will be discussed in the next chapter. It implies, as we shall see, that what may be the correct accounting basis for computing depletion may not be the most suitable basis for the analysis of investment values. Unfortunately, business practice in the oil industry has been such as to make the sound application of this principle exceedingly difficult. The oil-producing part of the industry has apparently accounted for most of the profits. The refining and marketing divisions have earned little, if anything, on their investment. If earnings were the criterion of value here, most of the market price of a typical oil stock would be ascribable to the producing division, and on this basis a comparatively high depletion charge against each barrel taken out would be called for. On the other hand, if the division were made in proportion to book values, the refining and marketing sections would loom large, the oil reserves would have a much smaller value, and the depletion charge would be proportionately smaller. We do not see any really satisfactory answer to the dilemma that we have posed, for it seems to us that the partition of earning power in the industry between production and the other branches is an essentially artificial one and cannot be viewed as permanent. We therefore are led to suggest the following practical compromise with the problem. 1. In the case of integrated oil companies, accept the company's depletion figure as the best available. This includes acceptance of the overall basis if used, since this method would seem to reflect the facts fairly. However, any charges for depletion made against an appreciation account in the balance sheet should be deducted from income. 2. In the case of companies that are solely oil producers, or virtually so, the analyst can compute what the market is paying for the total developed oil reserves, if an estimate of these is published. Hence, he can make his own depletion calculation for the particular purpose of his analysis, in such an instance in the same manner as in the case of a mining proposition. Other types of amortization of capital assets. Leaseholds and leasehold improvements. The ordinary lease involves no capital investment by the lessee, who merely undertakes to pay rent in return for the use of property. But if the rental payments are considerably less than the use of the property is worth, and if the arrangement has a considerable period to run, the leasehold, as it is called, may have a substantial value. Oil lands are leased on a standard basis for a royalty amounting usually to 1/8 of the production. Leaseholds on which a substantial output is developed or assured are worth a large bonus above the rental payments involved, and they are bought and sold in the same way as the fee ownership of the property. Similar bonuses are paid, in boom times usually, for long-term leases on urban real estate. If a company has paid money for a leasehold, the cost is regarded as a capital investment that should be written off during the life of the lease. In the case of an oil lease, the write-off is made against each barrel produced rather than on a time basis, since the output declines rapidly from the initial flush figure. These charges are in reality part of the rent paid for the property and must obviously be included in current operating expense. When structures are built on leased property or alterations made or fixtures installed, they are designated as leasehold improvements. Hence, their cost must be written down to nothing during the life of the lease, since they belong to the landlord when the lease expires. The annual charge-off for this purpose is called amortization of leasehold improvements. It partakes to some extent of the nature of a depreciation charge. Chain store enterprises frequently invest considerable sums in such leasehold improvements, and consequently the annual write-offs thereof may be of appreciable importance in their income accounts. Example: the December 31, 1938 balance sheet of F.W. Woolworth Company carried buildings owned and improvements on leased premises to be amortized over periods of leases, at a net valuation of $46,717,000. The charge against 1938 earnings for amortization of these buildings and leasehold improvements amounted to $3,925,283. Since these items belong to the amortization group, they lend themselves to the same kind of arbitrary treatment as do the others. By making the annual charge against surplus instead of income, or by writing down the entire capital investment to $1 and thus eliminating the annual charge entirely, a corporation can exclude these items of operating cost from its reported per-share earnings and thus make the latter appear deceptively large. Amortization of patents. In theory, a patent should be dealt with in exactly the same way as a mining property. That is, its cost to the investor should be written off against earnings during its remaining life. It is obvious, therefore, that charges made against earnings by the company, which are based on the book value of the patent, have ordinarily little relevance to the real situation. Consideration of this question belongs chiefly to a later chapter on amortization from the investor's standpoint, and to avoid dividing our treatment, we shall postpone to the same place our brief discussion of the accounting methods relative to patents encountered in corporate reports. Amortization of goodwill. This is a matter of very minor importance. A few companies have followed the rather extraordinary policy of charging off their goodwill account against earnings in a number of annual installments. Examples: Radio Corporation of America charged $310,000 a year for this purpose between 1934 and 1937. This was applicable to the goodwill account of its subsidiary, National Broadcasting Company, and was discontinued in 1938, although $1,876,000 remained unamortized. Obviously, this practice has no factual basis, since goodwill has no duration of life apart from that of the business as a whole. Where the item is of any size, the analyst should adjust the earnings by canceling the charge. Chapter 35. Public Utility Depreciation Policies. Omission of depreciation charges. In no field does the question of proper depreciation policy have such practical importance as in the public utility group. Yet nowhere have there been wider variations in both theory and practice. Some years ago, there were instances, notably that of Cities Service Company, of complete failure to make any deduction for depreciation and depletion in the annual reports, with a resultant gross misstatement of the earnings for the stock. The argument has often been advanced that depreciation charges may properly be ignored because they are mere bookkeeping entries and do not represent a real outlay of cash. This is a highly inaccurate statement of the case. Depreciation is not a mere bookkeeping conception because, for the most part, it registers an actual diminution of capital values, for which adequate provision must be made if creditors or owners are to avoid deceiving themselves. Moreover, in the majority of cases, the depreciation charges are consumed or offset over a period of time by even larger cash expenditures made for replacements or extensions. More often than not, therefore, depreciation charges are eventually found to be related to actual cash outlays and turn out to be as truly an expense of the business as wages or rents. Minority cases are fairly numerous in which a good part of the depreciation reserve remains unexpended over a long period of time. In these instances, a reduction of the annual charges may sometimes be justified in the investor's calculations, as we shall later explain. The broad principle remains, however, that an adequate depreciation allowance is essential in arriving at a fair statement of earnings. Other misleading practices. Another fairly prevalent practice was the deduction of only part of the depreciation charge from earnings, the balance being taken out of the surplus account. In some instances, the amounts charged to income were based on the so-called indenture minima, a percentage of gross earnings for maintenance and depreciation combined required to be deducted under the terms of a bond issue. When these indenture minima were less than the depreciation actually needed and taken, we find that requirements ostensibly set up for the protection of investors were actually used to mislead them. It is unfortunate that something resembling this practice has been resorted to at times by conservatively managed companies. An example may be found in the accompanying PDF regarding the reports of the Detroit Edison Company for 1931 and 1930. Although Detroit Edison's depreciation charges have been unusually liberal by comparison with the average for the industry, the accounting method employed for 1931 and also in 1934 might well be criticized for two reasons. In the first place, its effect, if not its purpose, was to disguise the actual decline in earnings from the previous year. Secondly, because of the high reputation of the company, this device was likely to be imitated by other enterprises, and thus it might furnish an unwholesome stimulus to the new practice of overstating earnings by the transfer of charges to the surplus account. An illustration of tricky accounting. An extraordinary example of tricky accounting is displayed by Iowa Public Service Company. For 1929, this company reported a property account of $25,200,000, gross earnings of $4,200,000, and a depreciation charge of only $78,000. The inadequacy of this figure is patent. In succeeding years, the depreciation allowance was gradually increased, reaching $220,000 in 1932, which was still a somewhat subnormal figure. In 1932, the company made formal confession of the insufficiency of its past depreciation charges by the following unique procedure. 1. It reduced the stated value of its common stock by $1,587,000 and transferred this sum to capital surplus. 2. It immediately used up this capital surplus by charging against it $1,500,000 for additional depreciation and $87,000 for contingencies. In this case, we see a good part of the necessary depreciation charge excluded from the income statements over a period of years, and finally allowed for by reducing the amount at which the common stock is valued. An incidental effect of this mischievous accounting was to permit the parent company, American Electric Power Corporation, to take out in dividends a sum exceeding the true earnings and the initial surplus combined, to the serious prejudice of the bondholders and the first preferred stockholders. Inadequate depreciation revealed by transfers from surplus and reserves. Example: the case of Brooklyn Union Gas is perhaps the most impressive example of the failure of the income account to reflect the necessary deductions for amortization. The extent of the consequent overstatement of earnings has been glaringly revealed by the huge transfers required to be made from surplus and contingency reserves. The story as regards the 10 years 1929 to 1938 may be found in the accompanying PDF. The figures found in the PDF are given in considerable detail since they disclose a complicated but significant state of affairs bearing on the true earning power of the company. The reader will note the following points. 1. The average reported earnings of $5.13 per share were computed after deduction of a retirement reserve of very small size in relation to both gross earnings and plant account. 2. These charges for retirements against income proved woefully inadequate to cover the actual retirements taking place during the period. To meet these charges, the company had to exhaust a large contingency reserve. 3. Although the company reported to stockholders that it had earned an aggregate of $51 per share during the period, paid dividends of $40 and carried $11 per share to surplus, its surplus and contingency reserve had really decreased about $26 per share. Hence, the earnings, as indicated by the balance sheet, had averaged only $1.36 per share instead of $5.13 per share as reported in the income account, $13,800,000 at the end of 1928, and to draw heavily on surplus besides. 4. The actual retirements of property during this period averaged $2,688,000 per annum, or 11% of gross, as compared with the charge to income of $729,000, or 3.1% of gross. In the year 1938, the company stated that, in accordance with the new requirements of the Public Service Commission of New York, it was adopting a depreciation policy, that the details had not yet been worked out, and that provisionally it was charging $1,200,000 per annum for the purpose. Judging from the facts stated in our previous discussion, there would seem to be grounds for doubt if even this amount, although much larger than former charges, is adequate. A variety of depreciation policies. The foregoing discussion of failure to reflect full depreciation charges in the income account leads us into a broader topic, viz., the basis used by a company in making its depreciation allowance. The methods employed reveal an extraordinary variety, no less than 7 calling for description as follows. A. Depredation proper. 1. Straight line method. Each class of depreciable property is written down to salvage value by equal annual charges during the period of its estimated life. This is the standard method of calculating depreciation permitted by the Revenue Acts and generally followed by all companies in their income tax returns. Surprisingly few electric and gas companies, however, have employed this method in their published income accounts. Example: Union Electric Company of Missouri, a subsidiary of North American Company, has used this straight-line method for a number of years. But even here, the company's reported allowance is less than that claimed on its income tax return, $3,899,205 versus $5,549,109 in 1937. The difference being due apparently to assuming a shorter life for tax purposes than for annual report purposes. As will be pointed out later, recent regulations adopted by state commissions and by the Federal Power Commission are now necessitating a changeover by many companies to the straight line or standard method in their reported earnings. 2. Sinking fund method. Allowance is here made for the fact that amounts set aside for depreciation will earn interest until the property is retired. The effect of this method is to make the deductions somewhat smaller in the earlier years and correspondingly higher in the later years. It is generally used by California utility corporations under agreements with the Railroad Commission of the state, the rate of interest allowed being 6%. Examples: Pacific Gas and Electric, San Diego Consolidated Gas and Electric. Even here, the companies take the straight-line basis in their tax returns. 3. The overall method. This applies a single annual percentage to the entire depreciable property account instead of varying rates to different classes of assets. The object, presumably, is to arrive at a simple approximation of the actual depreciation. Example: Commonwealth Edison deducts 3% of the average book value of depreciable property. B. Retirement reserve methods. The distinguishing feature of a retirement reserve is that it does not seek to measure the depreciation during a given period caused by wear and tear or obsolescence. Instead, it is supposed to provide funds that, in the opinion of the management, will be adequate to take care of retirements of property when and as they occur. Over any long period of time, proper depreciation and proper retirement allowances should total the same amount. But a retirement reserve policy apparently permits arbitrary annual variations to reflect good or bad earnings or the expected near-term need for actual retirements. In reality, as will be seen, the majority of retirement reserve policies operate simply to understate the current loss of property value and thus to overstate the earnings. Various bases of calculating retirement reserves are as follows. 4. Percentage of gross. This method would tend to approximate a regular depreciation rate if the percentage taken were adequate. Generally, this is not the case. Example: Duquesne Lighting Company deducts 8% of gross. On the other hand, its income tax deduction for 1932 to 1934 equaled no less than 30% of gross. 5. Fixed rate per unit of product. This method clearly resembles the preceding and is subject to the same criticism. Examples: In 1932, Brooklyn Union Gas Company stated that it was reserving 3 cents per 1,000 cubic feet for retirements. This policy has since been changed. Cincinnati Gas and Electric Company stated in 1937 that it was making provision for retirement reserve at the rate of 5 cents per 1,000 cubic feet of gas sold and $2.70 per 1,000 kilowatt hours of electricity sold. 6. Overall percentage of gross for maintenance and depreciation combined. By this method, the larger the amount spent for maintenance, the less is reserved for depreciation. Examples: Third Avenue Railway used a 20% deduction for maintenance and depreciation combined for the years 1912 to 1918. Tidewater Power Company uses varying total rates for different services, viz., in 1936, gas and electric 15%, water 12%, railway 30%. 7. Discretionary deductions. The majority of companies following the retirement reserve method have been bound by no mathematical formula, but have based the annual deduction largely on the judgment of the management. Examples: A. Amounts varying year by year. Detroit Edison, Philadelphia Electric, American Waterworks and Electric, American Power and Light. B. Unchanged annual round amount. Tampa Electric charged $430,000 per annum from 1933 through 1939. C. Allowance made equal to actual retirements during year. Western Union Telegraph Company in 1932 to 1936. The depreciation charge of $5,631,000 in its income account for 1936 compares with a provision of $11,190,000 in the tax return. The difference would account for most of the $7,199,000 reported as earned for the common stock that year. The inadequacy of past allowances for depreciation was shown by the transfer in 1937 of $30 million from surplus to depreciation reserve. Double accounting policies on depreciation. We have already stated that, regardless of what method is followed in the annual reports, practically every company follows the straight-line basis of depreciation in computing its income tax. The investor is thus confronted with a dual situation and a pressing problem. In many cases, it is of vital importance to know which basis of depreciation is correct, since bond interest coverage and common stock earnings, which may appear adequate, as reported in the company's annual statements, would turn out to be entirely insufficient if the income tax figures are accepted. Example: the existence of this disparity was unknown to investors generally until brought out into the open in one of the first prospectuses published under the terms of the 1933 Act, viz., that describing the American Water Works and Electric Company Convertible Fives, due 1944. This document revealed that in 1932, tax return amortization had been taken at $7,023,000 as against income account amortization of only $2,747,000. At that time, there was a tendency in Wall Street to minimize the significance of these divergences on the ground that depreciation was a highly technical and controversial matter, and there was just as much reason to accept the income account basis as the tax return basis. Reasons for accepting, in general, the income tax base. We have always been convinced that this heedlessness was dangerously unsound. Developments since 1934 have strongly buttressed our opinion, so that we now can advance no less than 5 major reasons for accepting, in general, the income tax figure rather than the income account basis of depreciation. These are: 1. The straight-line basis follows a definite and logical accounting theory. If it resulted in an excessive deduction, the Treasury Department would not accept it. The various retirement reserve bases are either entirely arbitrary or technically unsound. 2. The inadequacy of the retirement reserve idea in general has been shown by the necessity in many cases of making large transfers from surplus to bolster the retirement account. 3. Since 1934, there has been an almost universal increase in the retirement allowances, both absolutely and percentage-wise. This may be considered a virtual confession of past inadequacy. The extent of these increases is indicated by our table on page 474, which may be found in the accompanying PDF, which supplies information concerning depreciation or retirement allowances, as well as maintenance charges, covering the years 1930 and 1938 for a number of utility companies. It is to be noted that in the earlier year, the companies using the retirement basis generally made lower charges than those using the depreciation basis. Observe also that a number of the companies previously using the retirement method have since switched to a depreciation basis. Moreover, a considerable number of the companies that used the retirement basis in 1938 were on the verge of a transfer to a depreciation basis under the impetus of requirements of the Federal Power Commission and of various state commissions. 4. A number of state commissions and the Federal Power Commission have now ordered companies within their jurisdictions to follow a regular depreciation basis in all their accounts. Example: Pennsylvania, Michigan, and New York. Some important companies are perforce switching over to the income tax basis in their annual statements. For example, Consolidated Edison Company of New York for the calendar year 1938 charged $18,829,000 for retirement reserve in its report to shareholders and charged about $26,800,000 for depreciation on a straight-line basis in its income tax return. For the 12 months ending September 30, 1939, the company charged $24,217,000 for depreciation in its interim report to shareholders, as against a charge of only $17,737,000 in its report for the corresponding period ending September 30, 1938. Gross operating revenues for the latter two periods were $248,666,000 and $239,413,000 respectively. 5. Where any real alternative exists, the investor in fixed value securities must invariably apply the more stringent test of soundness. A comparative depreciation or retirement allowances of public utilities 1930 and 1938 may be found in the accompanying PDF. It is difficult to understand from these figures how the investor could justify to himself the purchase of Pennsylvania Power and Light $5 preferred at a price to yield only 5.26%. On the basis of the company's own report, the margin above fixed charges and preferred dividends was entirely inadequate. On the income tax basis for depreciation, this is cut by more than half. On the basis of the percentage of gross applied by Southern California Edison, the margin practically disappears. If we examine a very similar situation existing in 1930, we shall see how important it was for the investor to recognize the implication of the figures. In this case, we had three factors that militated against the investment merit of American Power and Light preferred stock. 1. The coverage as stated was entirely insufficient for real safety. 2. The depreciation rate taken was far too low. An adjustment to the Pacific Lighting basis would have sharply reduced the margin above preferred requirements. 3. These requirements were temporarily understated by about $2 million because a large preferred issue was then entitled to only $3 in dividends, the rate advancing gradually to $5 in 1933. The decline in the market price of the $6 preferred in 1988 was due to reductions in the dividend beginning in 1933, brought about in turn by lower net earnings which absorbed the small margin above preferred requirements existing in 1929. Recovery in reported earnings after 1933 was held back, in part, by the necessity of stepping up the depreciation allowance gradually to bring it in line with realities. Instances when income tax basis should be rejected or questioned. The reader may note that we have counseled acceptance of the income tax basis in general. The suggestion is qualified because there may at times be reasons either to accept the annual report figures or even to seek a third basis of amortization. The Pacific Lighting case used for comparison in the last example illustrates our first exception. The figures for 1929 were taken from the annual report and are based on the sinking fund depreciation method generally followed by agreement between the California Commission and California utility companies. It appears that the deductions for depreciation taken by the company average lower than the straight-line deduction taken on the tax returns. Nevertheless, in this case, the company's reported figures might well be accepted, first, because they result from applying an admissible accounting method, and second, because the amounts appear to be liberal in relation both to the property account and to the gross earnings. The same reasoning would apply to all the California utilities. There is another large group of companies that have taken depreciation allowances that appear liberal in themselves but are still substantially less than the income tax deductions. Examples. In 1938, Detroit Edison charged 13.5% of gross on its report to shareholders versus 18.2% of gross on its tax return for that year. Corresponding figures for North American Company for 1937 were 12.8% and 14.8% respectively. In these instances, the investor, and particularly the common stock buyer, may argue that the income tax basis is unduly severe. It is difficult to pronounce judgment on this point in the absence of detailed knowledge of the properties themselves and a better familiarity with public utility engineering details than we possess. We are inclined to advance the compromise suggestion that when the tax figure exceeds, say, 12.5% of gross, the latter rate be used provisionally for purposes of analysis. It may be pointed out that several years ago it appeared that 10 to 12% of gross constituted a comparatively liberal deduction. Practical effect of varying depreciation policies. The reader may consider this discussion of utility depreciation policies to be highly technical and uninteresting, but the fact remains that it has a bearing of the greatest practical importance on the selection of public utility stocks and on their market behavior. The companies that charged inadequate depreciation prior to 1934 were generally overvalued in the stock market because investors gave equally inadequate attention to this point. A careful analyst would have found many occasions to suggest transfers from less conservative to more conservative companies. Since in the following years there has been a tendency for the former group to step up their charges substantially, their reported earnings have been correspondingly held down, and their market prices also. The following example that may be found in the accompanying PDF illustrates this development. The price of American Water Works common in 1933 was apparently based on the reported earnings for previous years, without allowance for the fact that the retirement allowance was definitely inadequate. A good part of the decline in the amount available for the common 7 years later was due to the necessity for increasing the retirement allowance in line with the general tendency. The Pacific Gas and Electric exhibit is appended to demonstrate that the public utility stock buyer could have obtained much more for his money in 1933 had he been willing to scrutinize depreciation policies with care. Chapter 36. Amortization charges from the investor's standpoint. We have already made several references to the point that a depreciation or depletion charge that is technically proper from the accounting standpoint may fail to reflect the situation properly as it concerns the buyer of the company's stock at a given price. Problem indicated by hypothetical example. The point at issue may be more readily comprehended by the use at the outset of a simplified and therefore hypothetical example. Let us assume that companies A, B, and C are all engaged in the trucking business. Each has a single truck. Each is capitalized at 100 shares of stock, no par, and each earns $2,000 per annum before depreciation. Company A paid $10,000 for its truck. Company B paid $5,000 for its truck. Company C paid $5,000 for its truck, but followed an ultra-conservative policy and wrote its value down to $1. Assume that A's purchase of a dearer truck was an accident, and that in fact the managements of the three companies are equally capable and their general situation identical. The accountants give these trucks a depreciable life of 4 years. On this basis, the income accounts of the three corporations are as follows. Net before depreciation. Company A, $2,000. Company B, $2,000. Company C, $2,000. Depreciation at 25%. Company A, $2,500. Company B, $1,250. Company C, $0. Balance for common stock. Company A, $500 deficit. Company B, $750. Company C, $2,000. Earned per share, Company A, 0. Company B, $7.50. Company C, $20. Typical market appraisals. According to these audited statements, A is losing money, B is earning 15% on its capital, and C is doing very well indeed. An investor steeped in the recent wisdom of stock exchange valuations would consider the shares of Company A practically worthless, $5 per share perhaps being a generous appraisal. On the other hand, he might value the shares of B and C at about 10 times the earnings, which would produce $75 per share for B stock and no less than $200 per share for C stock. Such a procedure would result in the following total valuations for the three enterprises. Company A, $500. Company B, $7,500. Company C, $20,000. The absurdity of these valuations should be too patent for argument. Nevertheless, they represent merely a faithful application of current accounting methods and the established Wall Street reasoning. The results are, first, that a company with a less valuable asset is, for that very reason, declared to be worth more than a company with a more valuable asset. And, second, that by the single gesture of writing down its assets to zero, a company has been able to increase enormously the market price of its shares. Irrationality of these valuations disclosed by the balance sheet. The irrationality of these conclusions would be even more glaring if the balance sheets are examined. Assume that the companies have been in business 3 years and, for simplicity, that they started with no working capital. Company A, having lost money steadily, has of course paid no dividends. Company B has paid out 2/3 of its earnings, that is, $5 per share annually, and Company C has paid out 3/4 of its profits, or $15 per share. The balance sheets would then read as shown in the table on page 481, which may be found in the accompanying PDF. Although Company A has a profit and loss deficit, it has accumulated the largest amount of cash, presumably earmarked, as a depreciation fund. Company C, which has shown the largest earnings, has by far the smallest cash holdings. The suggested market value of $5 per share for Company A would amount to only 1/12 of its cash, whereas the price of $200 for Company C shares would equal more than 12 times the cash behind them. A more rational approach. These are the Alice in Wonderland results to which the accepted logic of the stock market would lead us. Let us now ask a more sensible question, viz., how would a businessman determine the reasonable value of these three enterprises? Common sense would tell him immediately that all three businesses, as such, independent of their assets, are of equal value. As a practical business matter, he would be inclined to place a somewhat higher valuation on the more expensive vehicle owned by Company A than upon the cheaper truck of Companies B and C. Nor is there the slightest doubt that this businessman will give full weight to the relative cash holdings of each company. His reasoning would therefore run somewhat as follows. Each business is worth, in the first instance, the amount of its cash plus the fair market value of its truck. Something might properly be paid also for the goodwill because the earnings on the average capital required for the business, after allowing for necessary depreciation, would be quite substantial. This goodwill value would be the same for all three enterprises. What is the relation of the company's depreciation charges to these valuations? The answer is that the charge made by Company B might well be accepted as relevant because it corresponds fairly well with the conditions of the business. Partly by coincidence, this fact results in making the businessman's valuation of Company B identical with that reached by the Wall Street method. But in the case of Company A and Company C, the depreciation charges made by the managements are entirely out of line with the realities of the business. In the one case, they have been made far too high because of the excessive cost of the fixed assets. Such an error should be corrected by writing down the property account and the capital account to a fair going value against which a business-like depreciation charge will accrue. In the case of Company C, the assets have been deliberately undervalued for the purpose of suppressing a depreciation charge that must be allowed for out of earnings because the owner's investment is actually depreciating. If the businessman or the investor is going to pay anything for the truck or for the business itself that requires a truck, he cannot avoid allowing for depreciation on the amount so paid by merely making believe that there is no such investment. Practical application of foregoing reasoning. Let us consider now how the foregoing reasoning may be applied to actual situations that confront the security buyer. Examples. As an initial example, we shall present the exhibit of the Eureka Pipeline Company for the 3 years 1924 to 1926. This may be found in the accompanying PDF. The final column would imply that during the 3 years under review there was practically no earning power for the shares, so that presumably the stock would have no value on a going concern basis. But would such a conclusion be justified from a business standpoint? The question will turn, as in our hypothetical examples, upon the correctness of the depreciation charges. The following data, also found in the accompanying PDF, will throw additional light upon this aspect of the Eureka Pipeline's record, figures in thousands. We find that the expenditures on property account averaged only $73,000 per annum, so that there was available in actual cash the sum of $368,000 per annum to be added to working capital or used for dividends, which were charged against previously accumulated surplus. It is clear that this business had been a producer of cash income for the owners, and for that reason it had substantial going concern value, although the high depreciation charges made it appear that there was none. How to determine the proper depreciation charge? In this case, therefore, as in our hypothetical example, the investor or the analyst must reject the company's basis for depreciation and endeavor to establish some other basis more consonant with the actual conditions of the business. How can the proper charge be determined? The answer was given without difficulty for the trucking companies because we knew just what depreciation had to be allowed for in order to maintain these enterprises in operation. But in practice, such exact knowledge is hardly ever available. We do not know how long the Eureka Pipeline's fixed assets will last or how much it would cost to replace them. The best we can do is formulate some rough estimates based on the discoverable facts. The only virtue of these estimates may be that they are, in all probability, closer to the mark than the company's figures, which we realize are untenable. Concept of expended depreciation. Taking a business attitude towards the Eureka Pipeline's exhibit, it is evident at the start that the depreciation allowance should be not less than the average expenditures made on the property. The primary reason for reducing the company's depreciation charges is that they do not properly reflect the cash available from operations. The expenditures on property account, including new fixed assets, represent in effect the portion of the depreciation reserve that is not available in cash, and that portion should hence be considered as the minimum amount of depreciation that must be allowed for in conducting the business. We may call this item the expended depreciation charge. If the increase in the property account exceeds the year's depreciation, then all of the latter must be considered as expended. In the case of Eureka Pipeline, such expenditures averaged $73,000 for the 3 years 1924 to 1926. This period is much too short upon which to base conclusions. But it happens that about the same results are shown by Eureka over a much longer period, so that the 1924 to 1926 figure may here be used as a basis of calculation. We must warn the student against deriving any notion as to the normal expended depreciation from examination of a short period, for example, less than 10 years, unless he knows that the nature of the business is such as to warrant a conclusion therefrom. Long-term depreciation, a form of obsolescence. The second question is what amount should be provided as a reserve to take care of the eventual wearing out of the entire property. In other words, for the major replacements that may have to be made at some distant date. This is the leading function of the depreciation charge in most theoretical discussions of the subject, and our trucking company examples were based on a simple application of this idea. The total fixed asset account having to be replaced at the end of 4 years. But we must recognize that in practice, such complete wearing out and replacement are of exceedingly rare occurrence. The typical corporation does not accumulate a large cash fund over a stretch of years, which is finally employed to replace the plant in its entirety at the end of its useful life. Factories do not actually wear out. They become obsolete. In 9 cases out of 10, plants are given up because of changes in the character of the industry, or in the status of the corporation, or in the locality where the plant is situated, or for other reasons not related to actual depreciation. These developments represent business hazards, the extent of which is not susceptible of any engineering or accounting measurement. Stated differently, The long-term depreciation factor is in reality overshadowed and absorbed by the obsolescence hazard. This risk is essentially an investment problem and not an accounting problem. It should not operate to reduce the earnings, as does a depreciation charge, but rather to reduce the price to be paid for an earning power subject to such a business risk. Application of foregoing in determining earning power. Let us endeavor to relate these conclusions to the Eureka Pipeline example. The expended depreciation charge has been found to average about $75,000 per annum. There are no indications that the entire plant will have to be replaced at any predictable date. On the contrary, the line appears to have an indefinite life due to continuous expenditures on maintenance, repairs, and renewals. In this respect, the enterprise resembles a railroad far more than it does a trucking company. According to our reasoning, only the expended depreciation charge should be deducted from earnings. The remainder of the depreciation factor is actually the obsolescence hazard, which is related to the possible exhaustion of the tributary oil fields. This should be considered after the earnings are arrived at and not before. A proper statement of the case would appear as follows. Eureka Pipeline, 1924 to 1926 basis. Item: earnings before depreciation. Total $442,000. Per share $8.84. Expended depreciation charge estimated $75,000 total, $1.50 per share. Balance: earning power subject to business hazards including obsolescence. $367,000 total, $7.34 per share. Problem of valuing the earning power. The company's figures showed no earning power for the period. Our figures show an earning power of over $7 per share, which clearly indicates substantial value for the enterprise. The price that may properly be paid for this earning power is subject to whatever considerations enter into buying a going business. This includes, on the one hand, the possibilities of increased profit and, on the other hand, all the multitudinous risks of loss, of which obsolescence of the fixed assets is only one. If, for example, it seemed conservative to require earnings of 20% on the investment to cover these hazards adequately, then the indicated value of Eureka Pipeline stock on the above showing would be about $35 per share. A detailed discussion of this point must be postponed, however, until we reach the topic of valuation of common stocks. For the purpose of this chapter, it should suffice to point out that in the actual case of Eureka Pipeline, as in the hypothetical case of Trucking Company A, it was both necessary and feasible for the investor to establish a depreciation allowance significantly different from that employed by the company itself. Depreciation on apartment and office buildings. In actual investment practice, the foregoing reasoning finds its widest application in the field of real estate securities. What is the true function of the depreciation charge in the analysis of the numerous bond issues secured by a lien on apartments or office buildings? Clearly, the deduction for depreciation is an accounting rather than an investment calculation. It is based on the assumption that the original cost is being used up by wear and tear in equal morsels over, typically, a 50-year period. But it would be an extremely rare coincidence for this arithmetic to correspond to the investment facts. Buildings of steel and stone do not actually wear out in 50 years. They become obsolete and are torn down after a life that depends for its length not on wear and tear but on real estate conditions. Furthermore, in the case of the huge number of real estate bonds that can be bought at large discounts from face value, the investor's write-off for both depreciation and obsolescence would be based on a cost to him much lower than the book value, which is subject to the conventional depreciation. The concept of expended depreciation may be useful in this field because the average expenditures for replacements must be considered as the equivalent of a cash operating expense. Parenthetically, it may be pointed out that this is an important factor in the analysis of hotel bonds. But it is even more important to warn the investor that hotel bonds should be viewed as obligations of a special type of business enterprise and not as a form of real estate security. Example: a brief analysis of the first mortgage bonds of 1088 Park Avenue Corporation, owning a large apartment building in New York City, will illustrate the points that we have been making. There are $1,851,000 of this issue outstanding, bearing fixed interest of 2 3/4% and contingent interest, depending on the amount of bonds retired, up to 2 1/4% additional. All of the stock of the corporation is attached to the bond issue. The average price in 1939 was about $35. Total market value of all securities, $653,000. Accounting details may be found in the accompanying PDF. Our analysis would suggest the following. 1. Assuming that 1938 revenues and expenditures are representative of the future and also that the reserve for capital expenditures made in that year is representative, there would be an indicated cash income for the bonds of $84,600 less $7,000, or $77,600. This would be 4.3% of par and 11.9% of the market price. 2. This percentage must be taken not only as applicable to a return on the investment, but also as an allowance for the obsolescence accruing against the building, which was constructed in 1925. But this obsolescence is governed not only by age, but also by changes in character of neighborhood, building styles, etc., factors that are almost indistinguishable from general business risks. 3. The investor may assume that out of the ample cash income he will receive fixed interest of 2 3/4% of par, or 7.86% of the market price. The balance, amounting to 4% of the market price, will be used by the company partly as a sinking fund to reduce the bond issue and partly for additional interest. What this really means is that the loss of value through obsolescence will be offset by cutting down the debt. The investor's judgment must decide whether or not A, the interest return is attractive as compared with the chances both of higher and lower net earnings, and B, the sinking fund operations will amply take care of the obsolescence factor. If his answer is decidedly yes, he would be warranted in regarding the issue as an attractive investment, not in spite of its low price, but because of its low price. 4. There is the possibility that obsolescence may be offset by appreciation due to a rise in real estate values, cyclical, secular, or inflationary. Reliance on such appreciation in the past has led many investors to ignore depreciation and obsolescence in their real estate purchases. We suggest that such possibilities must be viewed as speculative, that they do not cancel obsolescence but merely offer an offsetting attraction, and that an investment commitment in the bonds must be justified without including any such rosy expectation. Inadequate allowances for depreciation. Let us now consider examples involving the opposite type of situation, viz., the use of accounting methods by corporations that give rise to inadequate allowances for depreciation. Particular attention must be given to the vogue for drastic write-offs of fixed assets for the admitted purposes of reducing the depreciation charges and thereby increasing the reported earnings. This practice had its inception during the 1927 to 1929 boom, but its widest development took place in the ensuing Depression. Two typical cases are selected for discussion. Effect of writing down fixed assets. Unit, $1,000. Examples. Early in 1933, the United States Industrial Alcohol Company and the Safety Car Heating and Lighting Company announced plans under which the property account was written down to a net value of $1 by means of a corresponding reduction in stated capital and surplus. The transactions may be summarized in the condensed balance sheets shown in the table that may be found in the accompanying PDF. The United States Industrial Alcohol Revision was accompanied by a statement to the effect that, by reducing the book value of fixed assets to $1, the necessity for future charges for depreciation would be eliminated. It was proposed, however, to set up a reserve for replacements account by charges against income of amounts deemed sufficient to provide for the replacement of productive facilities. It was believed that for 1933, an adequate amount of such charge would be $300,000, which might be compared with approximately $900,000 charged against income for depreciation in 1932. The safety car announcement carried the idea even further. No provision for depreciation was made in 1932, so that a net profit was reported for that year against a loss for 1931, although income before depreciation was smaller in 1932. It was stated in the annual report of the company for 1932 that, by the elimination of depreciation on fixed assets as of December 31, 1932, all profits above operating expense and depreciation on subsequently acquired capital assets could be considered by your directors for distribution to the stockholders without any decrease in the company's current assets. Earnings manufactured from depreciation account. The procedure followed by Safety Car is identical with that of our imaginary trucking company C, which wrote down its truck to $1 and thereby avoided charging depreciation to earnings. We have already pointed out that if depreciation must be allowed for in fact, it cannot be eliminated by bookkeeping entries. The safety car stockholder does not earn $1 more on his investment because his fixed assets have been written down to nothing. Nor can necessary expenditures for plant upkeep or replacement be in any way reduced by making believe that there no longer is any plant. Let us examine the safety car heating and lighting exhibit in somewhat the same manner as that of Eureka Pipeline. Over a 10-year period, the expended depreciation charge averaged about $500,000 per annum. The earnings record for the decade is approximately as shown in the table found in the accompanying PDF. If this company were analyzed amid the uncertainties of 1933, it would be impossible to determine whether the long-term or the recent figures are a better guide to the future. But whatever assumption is made on this score, it is quite clear that a depreciation charge must be allowed for. If no better than the 1932 results can be expected, then a very small earning power at best would be indicated, since actual expenditures on plant will no doubt come close to, if they do not exceed, the reported earnings of $233,000. If by any chance the profits should return to their 10-year average, the complete elimination of the former depreciation charge would result in a serious overstatement of the true earning power. Sequel, 1933 to 1938. During this period, the company reported average earnings of $590,000 or $6 per share, after charging average depreciation of only $18,000. Had the 1922 to 1931 basis of depreciation been maintained, there would have been no earnings per share for the 6-year period and a substantial profit only in the year 1937. In that year, the earnings, as reported, reached $19.72 per share, and the price rose to $141, only to fall as low as $48 in 1938. The advance in 1937 might be ascribed to a twofold miscalculation of the market by, 1, considering the large volume of air conditioning installation done in that year as if it were fully recurring, and 2, ignoring the necessity for a depreciation charge substantially higher than the company's meaningless figure if such a volume were to continue. The United States Industrial Alcohol Company write-off did not result in the complete elimination of depreciation charges against earnings, but in lieu thereof it was proposed to set up a replacement reserve to be determined arbitrarily by the directors. For 1933, the amount was fixed at $300,000. A study of the approximate figures for the preceding 5 years would warrant grave doubts as to the adequacy of such a charge for replacements under normal conditions. In this case, the net plant account, gross plant less depreciation, increased $500,000 during the 5-year period. That is, from $18,800,000 at the end of 1927 to $19,300,000 at the end of 1932. In other words, the money spent for property extensions and replacements somewhat exceeded the total depreciation allowance of $6,750,000. This development is characteristic of most of our large corporations, which tend to add to their facilities as the years pass. In all such cases, it must be assumed that the depreciation charges, based upon accepted accounting rules, are the minimum necessary for properly reflecting the conditions of the business. They cannot soundly be reduced either by the corporation through arbitrary write-downs or by the investor in his individual calculations. Hence, if the United States Industrial Alcohol Company should regain its former profit-making ability, a drastic reduction of the former depreciation reserves would in all probability result in a misleading overstatement of the true earning power. Other examples of elimination of fixed assets. Commercial Solvents Company wrote down its plant account to $1 in 1932. May Department Stores and Kaufman Department Stores both wrote down their furniture and fixtures account to $1 in 1933 and 1929 respectively. Park and Tilford Company wrote down its machinery and fixtures account to $1 in 1927. In all these cases, subsequent depreciation charges were reduced to less than a suitable figure. Stock watering reversed. The new policy of writing off fixed assets bears an interesting relationship to the recent conceptions of stock values. It is a direct outgrowth of the ignoring of asset values and the monopolizing of attention by the reported per-share earnings. A generation ago, when investors consulted balance sheets to ascertain the net worth behind their shares, this net worth was artificially inflated by writing up the book value of the fixed assets far above their actual cost. This in turn permitted a corresponding overstatement of the capitalization at par. Stock watering, as this practice was called, constituted at that time one of the most severely criticized abuses of Wall Street. It is a striking commentary on the change in our financial viewpoint that the term stock watering has practically disappeared from the investor's vocabulary. By a strange paradox, the same misleading results that were obtained prior to 1914 by overstating property values are now sought by the opposite stratagem of understating these assets. Erase the plant account, thereby eliminate the depreciation charge, thereby increase the reported earnings, thereby enhance the value of the stock. The idea that such sleight of hand could actually add to the value of a security is nothing short of preposterous. Yet Wall Street solemnly accepts this topsy-turvy reasoning, and corporate managements are naturally not disinclined to improve their showing by so simple a maneuver. Purchasers' amortization of ore reserves. The distinction between the company's and the investor's allowance for amortization appears most clearly in cases involving depletion of ore reserves. As pointed out in Chapter 34, the amounts charged off by a mining company for depletion are based upon certain technical considerations which are likely to be quite irrelevant to the stockholder's situation. Example: in the table on page 494 found in the accompanying PDF, a study of the showing of Homestake Mining Company for the year 1925 and again for 1938 will illustrate this point. Superficially, the price of 63 early in 1939 would seem to be somewhat better justified by the past year's earnings than the price of 50 in early 1926. But the reported earnings were based upon the company's charges for depreciation and depletion, which bear no relation to the price which the purchaser of the shares is actually paying for the mine. It will again be helpful to view the picture from the standpoint of a businessman considering the purchase of the entire enterprise at the valuations indicated by the market price of the stock. In 1926, the valuation would be $12,500,000. For this sum, he would obtain about $2,500,000 in current assets, equivalent to cash, so that the mine and plant would cost him only $10 million. It is this capital investment which he would have to amortize, that is, recover out of earnings, together with a suitable profit before the mine is exhausted. In 1926, the developed ore reserves indicated a minimum life of 11 years for the property at the current rate of production. Since new ore had continuously been developed in amounts very nearly equal to the tonnage mined, there was good reason to expect a life considerably longer than the minimum figure. It would not be conservative, however, to count on more than 20 years. In a mining venture of this type, the same amortization rate should ordinarily be applied to the machinery and other equipment as to the mine proper, on the theory that the plant will last as long as the mine and will then have to be scrapped. Homestake Mining Company. The purchaser's amortization calculation. The purchaser's amortization rate would therefore have to be somewhere between 5 and 9% annually on his $10 million cost price for the mine. How this would work out is shown in the table on page 495, found in the accompanying PDF, which includes a corresponding analysis of the March 1939 situation. The same maximum and minimum figures for expected life are used in both cases because the reported ore reserves continued to show a life of at least 11 years. Huiataki Mining Company buys amortization calculation. From the business standpoint, the showing for 1925, assuming it could be expected to continue, would indicate a satisfactory return on the investment at $50 per share. This is by no means true so far as the available facts are concerned. When dealing with the 1938 earnings and the related price of about 63, the company's amortization charges for 1925 were considerably higher than required by a purchase of the shares at 50. But on the other hand, the buyer at 63 could not be at all sure that the company's charges for 1938, even though increased over 1925, would be adequate to amortize his investment. In the more frequent case where a mining company's charge for depletion is not shown in its report, the same general approach must be used in attempting an analysis. This means that where the life of a property is limited, the stated depreciation charge should also be ignored and the investor's amortization charged against the earnings before depreciation. The three factors to be considered are: 1. The price paid for the mining property, total price less cash assets; 2. The earnings before depreciation and depletion; and 3. The minimum life of the mine and, alternatively, its probable life. Purchaser's amortization of oil reserves. The application of this principle to the oil industry is shown most readily by selecting a company such as Texas Gulf Producing Company, which is solely a producing enterprise and has clearly stated the oil reserves on which the purchase of the stock must be based. It is true, of course, that the company's undeveloped leases may turn out to possess important additional quantities of oil, but that would be true of any large leaseholdings and cannot give them for the present any more than the nominal value represented by the cost of acquisition. Example: Texas Gulf Producing Company in 1937. 1. The situation. The significant facts relative to this company's amortization charges are relatively simple. The company is a producing enterprise solely. Most of its oil comes from a single field in Texas. Its depreciation and depletion charge per barrel is found by dividing the estimated remaining oil reserves into the net value of the properties on the books. In 1937, the oil reserves averaged about 26 million barrels, and the net property account about 9.5 millions, resulting in an amortization charge of $36.05 per barrel, or $689,000 for the year's production. Of this amount, however, only $397,000 was charged to earnings, the remainder being deducted from surplus arising from appraisal on the balance sheet. Earnings per share equaled $1.13 per share before amortization, 68 cents per share as reported, on the basis of amortization charged to earnings, and only 35 cents per share after full amortization, including the portion charged to surplus. Book value of the stock was about $10 per share. The market price in 1937 ranged between 9 5/8 and 2. 2. The investor's calculation. Omitting the possibility of new discoveries or developments, a non-measurable speculative factor, the purchaser of these shares would count on about 13 years of life remaining in the properties and would therefore deduct about 8% of his purchase price for annual amortization. Hence, at the high price of 9 5/8 in 1937, his amortization would about equal the company's total charge, and thus the remaining earnings would amount to only 4% on the price paid. At the year's average price of about 5 3/4, his allowance would approximate the company's charge to earnings, and at the low price of 2, it would need only 16 cents. And hence have left an indicated annual profit of 97 cents, or about 60% on the price paid. Purchaser's amortization of patents. A large number of important manufacturing companies own patents that are carried on their books at $1 or else at their cost, which is generally a relatively small amount. It is standard accounting practice to write off such cost by equal annual charges to earnings during the life of the patent, which is 17 years from the date it is granted. But the investor's viewpoint requires an entirely different approach. The question for him is how much is he paying for the patent when he buys the stock at a given price, and it is this amount that he must write off against the subsequent earnings. General rule. A little thought will show that in the typical case, no such calculation is practicable. The investor cannot tell what part of the price of the stock represents the current valuation of the patents, for he is in no position to gauge accurately the effect of the expiration of the company's patents upon its earnings. If we take concerns like General Electric or Radio Corporation of America, we know that their patents bulk large in the picture, but only the most exhaustive investigation could give us any idea at all as to how to allocate the current market value of the enterprise as between the innumerable patents and the other very real assets. Even when the situation appears much simpler, because a single important patent is at stake, it is easy to miscalculate its true importance to the enterprise. Examples. In the case of Gillette Safety Razor Company, the expiration of the basic patents was followed unexpectedly by a number of years of largely increased earnings and by an enormous advance in the market value of the shares. The opposite development occurred in the case of American Arch Company, which supplied patented arch brick for locomotives to nearly all the railroads of the United States. Because of the technical nature of its business and its strong trade position, those identified with this company were confident that it would hold its customers after its patents expired in 1926. But immediately thereafter, competition compelled a drastic cut in prices, the earnings dwindled, and the price of the stock collapsed. Our conclusion from all the foregoing must be that patents should not be valued as a quantitative factor when the investor is dealing with the ordinary manufacturing business. Patent ownership must be considered as part of the company's trade position, reflecting itself in one's general view of the future of the enterprise. It follows that the $1 valuation of patents is the soundest for the investor's purpose, that amortization of patents can be added back to earnings if the amount is substantial, and hence, if such amortization is charged to surplus instead of income, it is not necessary to correct the earnings figure. Special cases. When a company's business consists primarily in collecting royalties on a patent or group of patents, it is possible to make a more definite provision for amortizing the investment therein. It should be obvious that such provision must be related to the price paid by the investor for his interest in the patent, rather than to the company's book cost of the patent on which its own amortization charge is based. The following three examples illustrate this point, but they also emphasize a more significant factor which is present in all analyses applied to common stocks, viz., that calculations based on the present and the past can readily be upset by the unpredictable events of the future. Example A. Centrifugal Pipe Corporation in 1929. Conclusion vindicated. 1. The situation. This company controlled American and foreign patents on the de la Valde process for making metal pipe. Exclusive license to manufacture pipe under this process was given on a royalty basis to United States Cast Iron Pipe Company. The agreement extended to 1938, although the basic patents apparently expired in 1934. Various foreign licenses were also granted, expiring in 1934 to 1936. In 1929, the price of the stock varied between 4 1/4 and 13. Earnings both for 1928 and for 1924 to 1928 had been $1.05 per share on 432,000 shares before allowing for amortization of patents, which the company was taking at the annual rate of $1.72 per share. This was derived from an initial valuation of $7 million given the chief patents at the end of 1923, at which time they had 11 years to run. On this basis, the company showed a loss after amortization. 2. The investor's calculation. An analysis made in 1929 might have suggested earnings of about $1 per share for the 10 years ending with 1938, following which no additional profits could be counted on with assurance. The investor's annual amortization charges would thus vary between 43 cents and $1.30, corresponding to a purchase price between 4 1/4 and 13. Obviously, at $13 per share, there could be no earnings on the investment unless profits were greater than in the past. At $5 per share, on the other hand, the $1 estimate would yield an annual profit of 10% after allowance of 50 cents for amortization. 3. The sequel. Strangely enough, the results indicated at the beginning of 1929 were exactly realized in the following 10 years. In this period, the company earned $10 per share, of which it paid $6 in dividends. In 1939, it practically wound up its affairs by distributing $3.80 in cash plus a residual stock worth about 50 cents per share. Example B. Hazeltine Corporation in 1937. Calculation affected by new developments. 1. The situation. This company was organized in 1924 and controlled the Nutridyne patents for radio receivers, which apparently expired in 1936. Other patents were also acquired. In the ensuing 13 years, its results fluctuated widely, but it earned an average of about $2.40 per share, from which it reserved $1.50 per annum to amortize its patent account. Dividends were paid irregularly, averaging $1.70 per annum, mainly out of the reserve for amortization of patents. In 1936 alone, earnings before amortization were $3.70 per share. In 1937, the stock sold as low as $7, which was about equal to the accumulated cash assets, and as high as $18.50. 2. The investor's calculation. If the investor assumed that the company's chief revenue was derived from its Nutridyne patents, he would have concluded that the stock was too high at $18.50, since expiration of those patents in the near future would apparently severely reduce the future earning power. At $7, on the other hand, the stock could still appear cheap in view of the substantial cash assets and the prospects of some earnings from the remaining patents. Actually, this would have been a superficial analysis, since the record showed that the company controlled hundreds of patents of various sorts. Hence, nothing short of a careful inquiry into the details of Hazeltine's business would have warranted a conclusion as to the relative value of the expiring and continuing patents. 3. The sequel. The company's earnings proved to be fully as high in 1937 to 1938 as they had been in 1936. A new patent covering a coupling system used in most receiving sets was issued to it in 1938 and gave it as strong a position in the field as it formerly held. The price of the stock advanced to $30 in 1938 and to $36 in 1939. Example C. International Cigar Machinery Company in 1939. A current analysis. 1. The situation. This company's chief patents give it control over the manufacture of cigars by machine. It also owns other patents of less importance in the field. The original cigar machinery patents have apparently expired, but new improvements have maintained the company's position. Earnings have come mainly from royalties and sales of licenses. In the 10 years, 1929 to 1938, they varied between $2.08 and $3.33 per share and amounted to $2.28 in 1938 on 600,000 shares. These figures are after relatively small depreciation and amortization charges of about 30 cents per share annually. The company's balance sheet at the end of 1938 lumped all intangibles together at $14 million gross, of which amortizable patents must have represented a relatively small amount and non-amortizable goodwill the major portion. Net working capital and other tangible assets amounted to only $2 per share. In 1939, the price of the stock ranged between 20 and 24. 2. The investor's calculation. If the company's business were thought to be largely dependent on any single set of patents, an average price of 22 could not be justified, for in that case it would be unlikely that future earnings up to the expiry of the patents would be sufficient to pay back the investment in full plus suitable earnings thereon. In other words, any conservative amortization charge would condemn the purchase if based on the current patent situation alone. On the other hand, the market price may be justified if, in the future, the company can maintain its patent and license control of the industry by means of improvements in the art. This it has been able to do in the past. It may be benefited also by an increased use of machinery as against hand manufacture due to constantly lower selling prices for cigars. Obviously, therefore, the evaluation of this issue is essentially a matter for industry analysis and forecasting and not for the application of investment accounting technique to a definite state of facts. Rules summarized. Our lengthy discussion of amortization policies may be summarized in the following rules. Rule 1. The company's amortization charges are to be accepted in analysis whenever both A. They are based on regular accounting rules applied to fair valuations of the fixed assets, and B. The net plant account has not decreased over a period of years. Rule 2. The company's charges may be reduced in the analyst's calculations if they regularly exceed the cash expenditures on the property. In such a case, the average cash expenditures may be deducted from earnings as a provisional depreciation charge and the balance of depreciation included as part of the obsolescence hazard, which tends to reduce the valuation of the average cash earning power. The obsolescence allowance will be based upon the price paid for the enterprise by the investor and not upon either the book value or the reproduction cost of the fixed assets. Rule 3. The company's charges must be increased in the analyst's calculations if they are both less than the average cash expenditures on the property and less than the reserve required by ordinary accounting rules applied to the fair value of the fixed assets used in the business. Contingency and similar reserves. Conservatively managed companies in former days were wont to charge certain arbitrary amounts against the earnings of good years to absorb any special losses that might later arise, usually in a bad year. The intent of this policy was to equalize the earnings in prosperity and depression. In this respect, it resembled the use of accumulated earnings of subsidiary companies discussed in Chapter 33. Experience has shown that such devices for artificially modifying the actual earnings are too readily open to abuse. Intelligent financial opinion, as represented by the New York Stock Exchange, insists, therefore, that the management disclose the true results of each year and leave all equalization and averaging to be done by the stockholders. Examples. The annual report of the Coca-Cola Company for 1928 stated that The company's position has been greatly strengthened during the last 5 years by setting aside a reserve for contingencies of approximately $5 million. Reports for the preceding 5 years showed that the reserve had been accumulated by charges against income in varying amounts and for a miscellany of purposes. In the years 1929 to 1939, the policy was continued, except in 1933 and 1934, with the result that the reserve for contingencies and miscellaneous operations set up by charges against income amounted to $13,011,479 at the end of 1939. In 1939, Continental Steel Company deducted $300,000 as a reserve for contingencies from its reported earnings for the second half year, reducing the earnings per share from $4.62 to $3.13. Use of contingency and similar reserves to distort the earnings picture. During the years 1931 and 1932, however, contingency and similar reserves were resorted to by many companies with the effect of greatly obscuring and confusing their annual statements. These reserves were created for a threefold purpose. 1. To permit losses to be charged against surplus instead of against income. 2. To gloss over the actual taking of the loss. And 3. In some cases, to lay the groundwork for inflated earnings in subsequent years. A detailed analysis of the reports of American Commercial Alcohol Corporation for 1931 and 1932 may serve to make these points clearer to the reader. The results for the 2 years, as given by the company in its annual statements, were as shown in a table that may be found in the accompanying PDF. From these figures, it would appear that the company had about broken even during the 2 depression years taken together, and that it had realized substantial earnings during 1932. But the balance sheets covering this period point to an entirely different conclusion. These balance sheets show that instead of a merely nominal loss of $11,000 for the 2 years together, there was an actual shrinkage of $1,600,000 in the company's surplus, the greater part of which was represented by an increase in current debt. The extraordinary discrepancy between these two exhibits was brought about by the exclusion from the income account of numerous losses and deductions, which were charged against surplus instead. This simple device was made more complicated, and therefore not so readily intelligible to stockholders, by the use of 3 stages of accounting procedure, viz. 1. The transfer of a large amount from capital to capital surplus. 2. The transfer of various sums from capital surplus to reserves. 3. The charging of various losses against these reserves and of other losses directly against surplus. At the end of 1931, American Commercial Alcohol transferred the sum of $4,875,000 from capital to capital surplus. It then used $576,000 of this capital surplus to cancel the accumulated profit and loss deficit. The entries in the surplus account for 1931 and 1932 show a remarkable assortment of extraordinary losses and adjustments. This table may be found in the accompanying PDF. It is evident that a substantial part of these charges against surplus actually represented operating losses, which were responsible in turn for the large increase in current liabilities. It should be noted furthermore that the company carried forward into 1933 a new contingency reserve of $400,000, against which might be charged future losses that properly should reflect themselves in the income account. Hence, the accounting procedure of this company, as well as of many others in 1931 and 1932, not only concealed the true extent of the losses suffered, but also was calculated to understate the losses or to overstate the profits of succeeding years. A particular and frequent type of contingency reserve is a reserve for future inventory decline. In our discussion of various permissible methods of figuring inventory in Chapter 32, we pointed out that the normal stock method aims to mark down the basic stock to so low a figure that no drop in price will require further charge against earnings. This method involves, in essence, the use of a contingency reserve for future inventory decline, calculated in accordance with a definite and continuing policy. On the whole, we must regard a device of this kind as meriting praise rather than criticism. But it is essential that the analyst allow for the use of such reserves when studying a single year's results, and particularly when comparing several companies in the same field. Let us further remind the reader that the setting up of an inventory reserve out of surplus, whatever the theory behind it, almost invariably results in overstating the reported profits over a period of years. Chapter 37. Significance of the earnings record. In the last 6 chapters, our attention was devoted to a critical examination of the income account for the purpose of arriving at a fair and informing statement of the results for the period covered. The second main question confronting the analyst is concerned with the utility of this past record as an indicator of future earnings. This is at once the most important and the least satisfactory aspect of security analysis. It is the most important because the sole practical value of our laborious study of the past lies in the clue it may offer to the future. It is the least satisfactory because this clue is never thoroughly reliable and it frequently turns out to be quite valueless. These shortcomings detract seriously from the value of the analyst's work, but they do not destroy it. The past exhibit remains a sufficiently dependable guide in a sufficient proportion of cases to warrant its continued use as the chief point of departure in the valuation and selection of securities. The concept of earning power. The concept of earning power has a definite and important place in investment theory. It combines a statement of actual earnings shown over a period of years with a reasonable expectation that these will be approximated in the future unless extraordinary conditions supervene. The record must cover a number of years, first because a continued or repeated performance is always more impressive than a single occurrence, and secondly because the average of a fairly long period will tend to absorb and equalize the distorting influences of the business cycle. A distinction must be drawn, however, between an average that is the mere arithmetical resultant of an assortment of disconnected figures and an average that is normal or modal in the sense that the annual results show a definite tendency to approximate the average. The contrast between one type of earning power and the other may be clear from the following examples. The average earnings of about $4.50 per share shown by S.H. Kress & Company, which may be found in the accompanying PDF, can truly be called its indicated earning power, for the reason that the figures of each separate year show only moderate variations from this norm. On the other hand, the Hudson Motors average of $4.75 per share is merely an abstraction from 10 widely varying figures, and there was no convincing reason to believe that the earnings from 1933 onward would bear a recognizable relationship to this average. A similar conclusion was drawn from our discussion of the exhibit of J.I. Case Company earlier. These conclusions, reached in 1933, are supported by the results of the 6 years following. Again, this may be found in the accompanying PDF. Quantitative analysis should be supplemented by qualitative considerations. In studying earnings records, an important principle of security analysis must be borne in mind. Quantitative data are useful only to the extent that they are supported by a qualitative survey of the enterprise. In order for a company's business to be regarded as reasonably stable, it does not suffice that the past record should show stability. The nature of the undertaking, considered apart from any figures, must be such as to indicate an inherent permanence of earning power. The importance of this additional criterion was well illustrated by the case of the Studebaker Corporation, which was used as an example in our discussion of qualitative factors in analysis on page 87 earlier. It is possible, on the other hand, that there may be considerable variation in yearly earnings, but there is a reasonable basis nevertheless for taking the average as a rough index at least of future performance. In 1934, we cited United States Steel Corporation as a leading case in point. The text of our discussion was as follows. The annual earnings for 1923 to 1932 may be found in the accompanying PDF. If compared with those of Studebaker for 1920 to 1929, the foregoing earnings show much greater instability. Yet the average of about $8 per share for the 10-year period has far more significance as a guide to the future than had Studebaker's indicated earning power of about $6.75 per share. This greater dependability arises from the entrenched position of United States Steel in its industry, and also from the relatively narrow fluctuations in both the annual output and the profit per ton over most of this period. These two elements may be used as a basis for calculating approximate normal earnings of U.S. Steel somewhat as follows. Normal or usual annual production of finished goods, 13 million tons. Gross receipts per ton of finished products, $100. Net earnings per ton before depreciation, $12.50. Net earnings on 13 million tons, $160 million. Depreciation, bond interest, and preferred dividends, $90 million. Balance for 8,700,000 shares of common, $70 million. Normal earnings per share, $8. The average earnings for the 1923 to 1932 decade are thus seen to approximate a theoretical figure based upon a fairly well-defined normal output and profit margin. The increase in number of shares outstanding prevents this normal figure from exceeding the 10-year average. Although a substantial margin of error must be allowed for in such a computation, it at least supplies a starting point for an intelligent estimate of future probabilities. Examining this analysis 6 years later, we may draw some conflicting conclusions as to its value. United States Steel's earnings did recover to $7.88 per share in 1937, $8.31 before the surtax on undistributed profits. The price advanced from the 1933 average of 45.5 to a high of 126 in March 1937. Hence our implication that the company had a better earning power than the 1932 results and stock prices reflected would seem to have been amply justified by the event. But actually, the average earnings for 1934 to 1939 have been quite disappointing, amounting to no more than 14 cents per share. If these results have as much validity for the steel industry as they have for most lines of business, we should have to admit that the analysis based on 1923 to 1932 was not really useful, because the underlying conditions in steel have changed for the worse. The change consists chiefly in much higher unit costs and a lower average output, selling prices on the whole having been well maintained. Current earnings should not be the primary basis of appraisal. The market level of common stocks is governed more by their current earnings than by their long-term average. This fact accounts in good part for the wide fluctuations in common stock prices, which largely, though by no means invariably, parallel the changes in their earnings between good years and bad. Obviously, the stock market is quite irrational in thus varying its valuation of a company proportionately with the temporary changes in its reported profits. A private business might easily earn twice as much in a boom year as in poor times, but its owner would never think of correspondingly marking up or down the value of his capital investment. This is one of the most important lines of cleavage between Wall Street practice and the canons of ordinary business. Because the speculative public is clearly wrong in its attitude on this point, it would seem that its errors should afford profitable opportunities to the more logically minded to buy common stocks at the low prices occasioned by temporarily reduced earnings and to sell them at inflated levels created by abnormal prosperity. The classical formula for beating the stock market. We have here the long accepted and classical formula for beating the stock market. Obviously, it requires strength of character in order to think and to act in opposite fashion from the crowd, and also patience to wait for opportunities that may be spaced years apart. But there are still other considerations that greatly complicate this apparently simple rule for successful operations in stocks. In actual practice, the selection of suitable buying and selling levels becomes a difficult matter. Taking the long market cycle of 1921 to 1933, an investor might well have sold out at the end of 1925 and remained out of the market in 1926 through 1930 and bought again in the Depression year of 1931. The first of these moves would later have seemed a bad mistake of judgment, and the last would have had most disturbing consequences. In other market cycles of lesser amplitude, such serious miscalculations are not so likely to occur, but there is always a good deal of doubt with regard to the correct time for applying the simple principle of buy low and sell high. It is true also that underlying values may change substantially from one market cycle to another, more so, of course, in the case of individual issues than for the market as a whole. Hence, if a common stock is sold at what seems to be a generous price in relation to the average of past earnings, it may later so improve its position as to justify a still higher quotation even in the next depression. The converse may occur in the purchase of securities at subnormal prices. If such permanent changes did not frequently develop, it is doubtful if the market would respond so vigorously to current variations in the business picture. The mistake of the market lies in its assumption that, in every case, changes of this sort are likely to go farther, or at least to persist, whereas experience shows that such developments are exceptional and that the probabilities favor a swing of the pendulum in the opposite direction. The analyst cannot follow the stock market in its indiscriminate tendency to value issues on the basis of current earnings. He may on occasion attach predominant weight to the recent figures rather than to the average, but only when persuasive evidence is at hand pointing to the continuance of these current results. Average versus trend of earnings. In addition to emphasizing strongly the current showing of a company, the stock market attaches great weight to the indicated trend of earnings. In Chapter 27, we pointed out the twofold danger inhering in this magnification of the trend, the first being that the supposed trend might prove deceptive, and the second being that valuations based upon trend obey no arithmetical rules and therefore may too easily be exaggerated. There is indeed a fundamental conflict between the concepts of the average and of the trend as applied to an earnings record. This may be illustrated by the following simplified example found in the accompanying PDF. On the basis of these figures, the better the trend when compared with the same current earnings, in this case $7 per share, the poorer the average, and the higher the average, the poorer the trend. They suggest an important question respecting the theoretical and practical interpretation of earnings records. Is not the trend at least as significant for the future as the average? Concretely, in judging the probable performance of companies A and C over the next 5 years, would not there be more reason to think in terms of a sequence of $8, $9, $10, $11, and $12 for A, and a sequence of $7, $6, $5, $4, and $3 for C, rather than in terms of the past average of $4 for A and $10 for C? The answer to this problem derives from common sense rather than from formal or a priori logic. The favorable trend of Company A's results must certainly be taken into account, but not by a mere automatic projection of the line of growth into the distant future. On the contrary, it must be remembered that the automatic or normal economic forces militate against the indefinite continuance of a given trend. Competition, regulation, the law of diminishing returns, etc., are powerful foes to unlimited expansion, and in smaller degree, opposite elements may operate to check a continued decline. Hence, instead of taking the maintenance of a favorable trend for granted, as the stock market is wont to do, the analyst must approach the matter with caution, seeking to determine the causes of the superior showing and to weigh the specific elements of strength in the company's position against the general obstacles in the way of continued growth. Attitude of analyst where trend is upward. If such a qualitative study leads to a favorable verdict, as frequently it should, the analyst's philosophy must still impel him to base his investment valuation on an assumed earning power no larger than the company has already achieved in a period of normal business. This is suggested because, in our opinion, investment values can be related only to demonstrated performance, so that neither expected increases nor even past results under conditions of abnormal business activity may be taken as a basis. As we shall point out in the next chapter, this assumed earning power may properly be capitalized more liberally when the prospects appear excellent than in the ordinary case. But we shall also suggest that the maximum multiplier be held to a conservative figure, say 20 under the conditions of 1940, if the valuation reached is to be kept within strictly investment limits. On this basis, assuming that general business conditions in the current year are not unusually good, the earning power of Company A might be taken at $7 per share, and its investment value might be set as high as $140. The divergence in method between the stock market and the analyst, as we define his viewpoint, would mean in general that the price levels ruling for the so-called good stocks under normal market conditions are likely to appear overgenerous to the conservative student. This does not mean that the analyst is convinced that the market valuation is wrong, but rather that he is not convinced that its valuation is right. He would call a substantial part of the price a speculative component in the sense that it is paid not for demonstrated but for expected results. This subject is discussed further in Chapter 39. Attitude of analyst where trend is downward. Where the trend has been definitely downward, as that of Company C, the analyst will assign great weight to this unfavorable factor. He will not assume that the down curve must presently turn upward, nor can he accept the past average, which is much higher than the current figure, as a normal index of future earnings. But he will be equally chary about any hasty conclusions to the effect that the company's outlook is hopeless, that its earnings are certain to disappear entirely, and that the stock is therefore without merit or value. Here again, a qualitative study of the company's situation and prospects is essential to forming an opinion whether at some price, relatively low of course, the issue may not be a bargain despite its declining earnings trend. Once more, we identify the viewpoint of the analyst with that of a sensible businessman looking into the pros and cons of some privately owned enterprise. To illustrate this reasoning, we append the record of net earnings for 1925 to 1933 of Continental Baking Corporation and American Laundry Machinery Company. These statistics may be found in the accompanying PDF. The profits of American Laundry Machinery reveal an uninterrupted decline, and the trend shown by Continental Baking is almost as bad. It will be noted that in 1929, the peak of prosperity for most companies, the profits of these concerns were substantially less than they were 4 years earlier. Wall Street reasoning would be prone to conclude from this exhibit that both enterprises are definitely on the downward path. But such extreme pessimism would be far from logical. A study of these two businesses from the qualitative standpoint would indicate first that the respective industries are permanent and reasonably stable, and secondly that each company occupies a leading position in its industry and is well fortified financially. The inference would properly follow that the unfavorable tendency shown during 1925 to 1932 was probably due to accidental or non-permanent conditions, and that in gauging the future earning power, more enlightenment will be derived from the substantial average than from the seemingly disastrous trend. Deficits a qualitative, not a quantitative factor. When a company reports a deficit for the year, it is customary to calculate the amount in dollars per share or in relation to interest requirements. The statistical manuals will state, for example, that in 1932, United States Steel Corporation earned its bond interest deficit 12.40 times, and that it showed a deficit of $11.08 per share on its common stock. It should be recognized that such figures, when taken by themselves, have no quantitative significance, and that their value in forming an average may often be open to serious question. Let us assume that Company A lost $5 per share of common in the last year, and Company B lost $7 per share. Both issues sell at $25. Is this an indication of any sort that Company A stock is preferable to Company B stock? Obviously not. For assuming it were so, it would mean that the more shares there were outstanding, the more valuable each share would be. If Company B issues 2 shares for 1, the loss would be reduced to $3.50 per share, and on the assumption just made, each new share would then be worth more than an old one. The same reasoning applies to bond interest. Suppose that Company A and Company B each lost $1 million in 1932. Company A has $4 million of 5% bonds, and Company B has $10 million of 5% bonds. Company A would then show interest earned deficit 5 times, and Company B would earn its interest deficit 2 times. These figures should not be construed as an indication of any kind that Company A's bonds are less secure than Company B. 3. The investor may assume that out of the ample cash income he will receive fixed interest of 2 3/4% of par, or 7.86% of the market price. The balance, amounting to 4% of the market price, will be used by the company partly as a sinking fund to reduce the bond issue and partly for additional interest. What this really means is that the loss of value through obsolescence will be offset by cutting down the debt. The investor's judgment must decide whether or not A, the interest return is attractive as compared with the chances both of higher and lower net earnings, and B, the sinking fund operations will amply take care of the obsolescence factor. If his answer is decidedly yes, he would be warranted in regarding the issue as an attractive investment, not in spite of its low price, but because of its low price. 4. There is the possibility that obsolescence may be offset by appreciation due to a rise in real estate values, cyclical, secular, or inflationary. Reliance on such appreciation in the past has led many investors to ignore depreciation and obsolescence in their real estate purchases. We suggest that such possibilities must be viewed as speculative, that they do not cancel obsolescence but merely offer an offsetting attraction, and that an investment commitment in the bonds must be justified without including any such rosy